Hey, if you didn't catch the previous video about why cash flow is such an important metric for beginner, and honestly even pro investors, click the link below to check it out, and then head back here for your second lesson. All caught up? Fantastic. Let's dive into what good cash flow looks like. This isn't something that's always easy to gauge, as many companies with high rates of free cash flow can be poor stock performers and vice versa. So what you really want to look at here is the free cash flow trend. By looking at the free cash flow trend, you're able to tell whether or not a company's cash flow has been stable over the past 4 to 5 years. Using this Salesforce.com breakdown as an example, you'll see that free cash flow has consistently increased since 2017. In general, a positive free cash flow trend indicates that the company's a pretty good bet. If you want to look deeper into things, take a look at the free cash flow yield. That number will tell you whether or not the stock price provides a good value for the amount of free cash flow being generated by the company. A company's worth looking into if the free cash flow yield is above 4%, and anything above about 7% is a pretty great stock worth at least researching a bit more. Is that all you should be looking at when deciding which companies to invest in on the stock market? Nah, but it's a pretty good place to start if you need to learn how to quickly weed out which stocks are absolutely not worth your time. While we've got you here though, let's take a look at that Salesforce.com example. Would I invest in this company with these current numbers? Growth is the only thing that's a bit worrying here, but the free cash flow yield looks like it'll keep increasing after 2021. Overall, it's worth researching a bit more. For more information about investing and more minority-focused financial tips, check out the links in the description below. For even more investing tips like this, subscribe to our channel.